Have you ever been on vacation, you swipe your card for a coffee, and when you check your bank account later, you're like, wait, why did that cost so much? Or maybe, why was that so cheap? It feels like our money's value just completely changes the moment we cross a border. So let's break down exactly why that happens.
Okay, to make this super clear, let's invent a traveler. We'll call him Bob. Bob is starting his trip with some good old US dollars in his wallet. But as you're about to see, the value of that cash is about to go on a wild roller coaster ride.
So first up, Germany. Bob goes to exchange his money, and he finds out that his $1 is now worth less than €1, only about 90 euro cents. It kind of feels like he lost money just by hopping on a plane.
But hold on, his next stop is Vietnam. And all of a sudden, his $1 bill is worth a whopping 25,000 Vietnamese dong. He's basically at tens of thousands there overnight. So what is going on here? Why isn't $1 just $1 everywhere?
To solve Bob's money mystery, we actually need to rewind the clock a little bit and figure out where money's value even comes from in the first place. You see, it hasn't always been this complicated.
For a long time, much of the world was on what's called the gold standard. This meant a country's currency was literally backed by actual physical gold sitting in a vault. But, that system turned out to be a little too rigid for our modern, fast-moving economies. So around the 1970s, pretty much everyone shifted to what we use today, fiat money.
And this right here is the key. Under the gold standard, value is something you could touch. With fiat money, which is what we all have in our pockets, it's not backed by anything physical. Its value comes from two things: our trust in the government that issues it, and the simple, powerful forces of supply and demand.
All right, so if supply and demand are running the show, what are these big forces that are constantly pushing and pulling on a currency's value every single second of every day? Let's get into the big ones. First up is a big one, inflation. This is basically when your money loses its ability to buy stuff. If a government prints way too much cash but doesn't have more goods or services for people to buy, each dollar or peso or yen becomes less valuable. And here's the bottom line: investors will run from a currency that's basically melting in their hands.
This is a perfect way to picture it. Let's say back in 2022, your $10 bill could buy 2 loaves of bread. But if inflation kicks in hard, by 2024, that exact same $10 bill might only get you 1 loaf. The note itself hasn't changed, but its purchasing power, has been cut in half.
And if you want to see what happens when inflation goes completely off the rails, just look at Zimbabwe. In the 80s, their dollar was actually worth more than a US dollar. But after years of economic chaos and just printing endless amounts of money, hyperinflation totally wiped out its value. That is the destructive power of inflation.
Okay, next up, interest rates. The easiest way to think about this is like a savings account for the entire world. When a country's central bank raises its interest rates, it's basically offering a better payoff. Well, that gets the attention of global investors. To get in on that deal, they have to buy the local currency. And boom! All that buying increases demand, and the currency gets stronger.
But, and this is a huge but, there's a catch. You can't just jack up interest rates to the moon. Sure, it pulls in foreign money, but it also makes it way more expensive for your own people and businesses to borrow money for things like mortgages or building a new factory. It's this really tricky tightrope walk that can end up slowing down your whole economy.
So besides just high returns, what are these investors looking for? Well, they want one thing above all else: stability. A predictable government, a healthy economy with its act together. Those are massive green lights. Just think about when China started opening up its markets. It was seen as this huge new frontier for growth, and that confidence sent a flood of investment pouring in, which drove up demand for their currency.
And finally, let's talk about trade. The simple act of a country buying stuff from the world and selling its own stuff to the world has a huge impact on its currency.
Here's how it works. When Japan sells its cars all over the world, that's an export, buyers in other countries have to get their hands on Japanese yen to pay for them. That buying pressure increases the demand and the value of the yen. But on the flip side, when Japan needs to buy coal from Australia, that's an import, it has to sell its yen to buy Australian dollars, which boosts the value of the Australian currency. So the bottom line is, if you sell more than you buy, there's usually higher demand for your money.
So now that we understand all these forces, here's where it gets really interesting. Countries don't just sit back and let this stuff happen. They actively try to manage their currency's value as part of their bigger economic strategy.
And this is a really key idea. Stronger isn't always better.
A strong currency is fantastic if you're a country that imports a lot of stuff, like Singapore, because it makes all those foreign goods cheaper for your people. But if you're an export-heavy economy like China, you might actually want a slightly weaker currency. Why? Because it makes your products cheaper and more attractive to the rest of the world.
Some smaller countries take a shortcut to stability with a strategy called pegging. They literally lock or peg their currency's value to a stronger one, like the US dollar. The Belize dollar, for instance, is always worth exactly 50 US cents. It's a great way to build confidence, but the flip side is you've pretty much handed over the reins of your economic policy to another country.
You know, all this complexity, all these moving parts, it kind of leads to a pretty logical question, right? Why deal with all this? Why don't we just simplify the whole thing and have one single currency for the entire world?
I mean, it sounds amazing in theory, doesn't it? No more exchange rate fees, no more confusion for travelers like Bob. But the world's biggest experiment with this very idea, the Eurozone, shows us that it's a lot more complicated than it sounds.
The upside is obvious. It makes travel and trade between member countries incredibly smooth. But the challenge is huge. Countries have to give up control of their own money. They can't raise or lower their own interest rates to fix their own unique problems. And the biggest risk is contagion. As we saw with the Greek financial crisis a while back, one country's severe economic problem can quickly threaten the stability of the entire group.
And that's the heart of the issue. With a single global currency, one country's major economic blunder wouldn't just be their problem. It could become a global crisis, putting everyone, everywhere, at risk. So that leaves us with one final thought. We tend to think of a strong currency as being good and a weak one as being bad. But after everything we've looked at, maybe the real question is this: is a currency's value truly a measure of a country's strength? Or is it simply one of the most powerful tools a nation has to play its hand in the incredibly complex game of the global economy?